From San Diego, California, this is the Frug Life Podcast, the show that teaches you how to save, invest, and earn money. Here's the host, Mr. Frugal himself, Ricky Hirsch.
Welcome to the Frug Life. Recently, one of the top fans of the show, Daniel, shout out to Daniel, asked me to value two stocks, Amazon and Target. Or really, he asked me if they were a good investment. And my immediate answer to that is, well, one, I'm not an expert at valuing stocks per se. And these are publicly traded stocks that are well traded and, have a well-established market. And so I think it's going to be difficult to price this more efficiently than the market does. That all said, that would be a pretty boring episode if I ended right there and just said, the market's pretty good at pricing things, and the sales price, the value of the stock today is the value of the stock, and so it's worth exactly what it's worth. That would be a rather boring episode. Instead, I'm not going to talk so much about these two stocks in particular. I may do another episode on them. I need to do a little bit more research to try to come up with something. Instead, I'm just going to talk about valuing things in general. So there's many ways to value things. The first one, I think, is the most straightforward, and that is just figuring out a price at which this item will sell. So let's say you have a piece of real estate, and let's say you want to sell your house. If someone comes to you with an offer to buy your house, we'll say for $1 million, you could say that the value of your house is $1 million because you have an offer from someone to buy your house at that price. Now, what are some downsides of valuing a house this way? Well, one of them is you might not have an offer, in which case, if no one's offering to buy your house, or you want to figure out what your value is before you put it on the market to see if those offers are good offers, it doesn't work. Secondly, just because you have an offer, right, doesn't necessarily mean they'll go through and actually purchase it. It also doesn't necessarily mean that that's the true fundamental value of the thing. After all, they could be giving you a lowball offer. With a stock, this is pretty straightforward, though. The price at which something is selling is the market observable price, kind of like I was alluding to at the beginning. So let's think of another way to value something. Instead of looking at the value of your house, you could compare it to your neighbor's house who recently sold. In other words, you could look at things that are comparable to the thing that you want to value. And again, with comparables, you would look at other similar properties in the area that have sold. Using comparables is only as good as your comparables. So if you compare your house to a house that is in, say, another state, it probably isn't very comparable, and it's probably not that helpful. Likewise, if you looked at just the price of your house versus the price of a much larger house, that also would probably get you some skewed results. So instead of directly comparing them, you could adjust for square footage. One thing I did when I was buying a house was to create a little model. And in the model, I looked at a bunch of houses in the area of the house that I was thinking of buying. I looked at recent sales, and I looked at a number of variables and created a linear regression. Basically, this model took in the sales data, and it looked at the square footage of the house, it looked at the number of bedrooms, it looked at the number of bathrooms, and it looked at the lot size. And it took all those variables in, and it spat out a number. And so having, this many bedrooms is worth, or having each additional bedroom was worth, say $50,000 to the house's value. A bathroom was $100,000 and so forth. I'm just giving rough numbers. It wasn't anything exactly like that. So how does this concept relate to a stock? Well, when valuing a stock, you could look at peers. You could look at similar retailers and see what they are selling at. Now, of course, just comparing one stock price to another stock price isn't going to be very meaningful. So instead, you need to also incorporate ratios. And so a very common ratio that we look at is price to earnings. So the numerator of this ratio is the stock price. The denominator of this ratio is earnings, or to be more exact, earnings per share. Now, there's a bunch of different ways to measure PE, right? You can look at earnings in T0, T1, T negative 1. And what do I mean by T1, T negative 1, T0? Like T0 just generally means right now. T1 would be 1 year in the future. T negative 1 would be like 1 year ago. Which exact metric you use is up to you. There's probably some more science in it that I'm not privy to, because again, I don't do this for a living. So how do we use price to earnings? So we could look at a competitor. We could see that their price to earnings ratio was, let's just say, 20. And let's say that the company that we want to value has earnings per share of $1. Using some very simple math here, we can see the value of a share of stock of that company, if that price to earnings ratio is meaningful, is $20. 20 times the $1 earnings per share. What are some other ratios we could use? Let's say you're valuing a company that makes money but is currently generating a loss. Then that earnings per share metric is like negative, and this price to earnings ratio isn't inherently meaningful. A lot of times at that point, people just move up the income statement in finding a ratio that's meaningful. And so if earnings per share isn't meaningful, you'd go up and you'd look at maybe operating income. And if operating income isn't profitable, you'd go up all the way to revenue up at the top line. And you might look at some ratio of price to revenue divided by shares outstanding. Now, I think one thing to keep in mind when using ratios is ratios are, to me, the icing on the cake of valuing a company. Ratios, to me, isn't your go-to way to value a company. And really, it's what you do when you don't have very much information. And so I think a better way, and the third way that we're going to talk about valuing something, is through discounted cash flows. When we're talking about real estate, this scenario is more something like you have a house that you're going to use as a rental property. You look at the amount of money you expect to take in from the property, minus any expenses related to it, and then you account for the time value of money. I think I don't really want to explain the time value of money in great length in today's episode. Let's just keep it very simple and say that a burrito today is better than a burrito tomorrow. Just inherently, if you could have something today versus having it tomorrow, you'd rather have it today. That's what the time value of money is in its most simple terms. It's better to have things now than later. One of my professors at BYU often used a burrito as an example here. Anyways, with a stock, you can do the same thing as that rental property. You look at the expected revenue of a company, and to build this model, you really have to have assumptions about what the revenue of the company will be in the future. And that could be difficult. The company does give some guidance, although just using the company's guidance to build your model doesn't really give you any edge over your competitors or other investors who are also building a model. To value a stock this way, I feel like you really need to have some knowledge that's not available to the general public. And now I'm not talking about insider trading because that's illegal. And not to go too much on a tangent here, but insider trading really is generally limited to insiders of the company who have non-public information and them trading on that information or providing that information to others. What I mean by non-public information is if you somehow had better expectations of what retail sales were going to be in the near future, you could use that information in a model and have an informational edge and then price the stock more effectively than other investors. And with that informational edge, you could make money because you know more than other people. As a retail investor, and by retail investor I mean someone who's not a professional investor, I think it is generally tough to have that kind of informational edge. That is high level why I recommend investing in ETFs, mutual funds, diversified investments rather than picking individual stocks. That said, if you really did want to pick individual stocks and research companies, you might want to try to research companies that aren't well researched already. Like Amazon and Target have tons of analysts all looking at them. Large institutional investors look at them, and it's very competitive, and I think there is very little price inefficiency in a large cap stock. Now, in a smaller cap stock, there might be some informational inefficiency. That said, you might be signing yourself up for a bit of a job doing all that research. All right, let's take a quick break and we will be right back. This podcast was brought to you by Leafbound Review, where you can get a free review of your book for free. Go to leafboundreview.blogspot.com for more information. Welcome back. I just wanted to close out today's episode with a few things. One is a disclaimer that, as usual, this is not financial advice. This is just me rambling with a microphone. I did use a different microphone today. I'm not sure how it's going to turn out. It might not be as good as usual. I think this microphone is a little bit cheaper. That said, my nicer microphone seems to be dying on me, and that is bad. If you have an idea that you want on the show, just let me know. It might happen, or I might go on a tangent that is somewhat related to your idea. Anyways, thanks for listening to today's episode of the show. Have a great month, and as always, stay frugal.